Karamutseneza. Good morning to you all watching this morning. I hope you're keeping healthy and staying safe. And welcome to the third webinar of our Fired Up for Finance series. Today's discussion will be about the new law, the law on the company law on business structures and corporate governance for organizations. This discussion will be to really highlight the new additions in the company law, to discuss its competitiveness compared to other centers, its expected impact on the local economy, as well as best practices in corporate governance, business structures, and the value proposition for the Kigali International Financial Centers. And this morning, we brought you some stellar panelists with us. And I'll start to my left. With us today, we have Richard Barenzi, who is a partner with Trust Law Chambers. He heads its banking and finance and capital markets practice. He practiced business law for over 13 years. His broad practice includes advising companies on setting up, financing, mergers and acquisitions, and listing on the Rwanda Stock Exchange. He holds a master's in corporate and finance law from the University of Glasgow. He also holds a BA, honors law with French, from the University of Nottingham in the UK, with the Université de Nantes, and a diploma in legal practice from the Law Development Centre in Uganda. Welcome to the panel, Richard.
Thank you, Michelle.
Right next to Richard, we have Anthony Mukulu. Anthony is the Chief Legal Officer and the company's secretary at Rwanda Finance Limited. He's responsible for legal advisory, regulation, and compliance. He's also a seasoned lawyer with vast experience in finance, dispute resolution, business transactions, investment, trade policy, and trade law, and I could go on and on. Before joining Rwanda Finance, though, Anthony worked at the Ministry of Justice in the Attorney General's office from 2008 to 2019. There, he rose to the position of Senior State Attorney. He has served as a board member of the Kigali International Arbitration Centre and was the chief legal expert on the Rwandan team, which successfully negotiated the Africa Continental Free Trade Area Agreement. Welcome, Anthony.
Thank you, Michelle.
And last but not least is Richard Kayibanda, who is the current Registrar General at Rwanda Development Board since 2018. Richard is also a seasoned lawyer, but he was a lecturer of law at the University of Rwanda in 2009, and he practiced law. He's a practicing lawyer and a member of the Rwanda Bar Association and East African Law Society. He's a certified mediator, and he holds a master's degree in business law from the University of Rwanda, has a diploma in legal practice from the Institute of Legal Practice and Development, and he has carried out consultancies for both public and private institutions on legal subjects. Welcome to our panelists, and welcome to you, Richard.
Thank you, Michelle.
So I'll get started. We have about an hour with you today, so we want to make the most of it. We'll start with Richard. Richard Kayibanda. We have two Richards on the panel. Richard RG, I'll say, for Registrar General. This new company law has a number of new business structures, and one of them being protected cell. Can you tell us more about the nature, the characteristics, and benefits of a protected cell company?
Thank you, Michelle. As you indicated in your introductory remarks, a number of laws have been amended to adopt best practices from world over, and the company law has been also amended, or rather revised recently. It was gazetted in February this year, and one of the key changes or new aspects that were introduced is a new type of company, that is the protected cell company. This is a new type of company in Rwanda, but it's not new in other jurisdictions. And basically, this is a company that, as the name indicates, will have a core and different cells. It will be a single, or it is a single legal entity, but with a core that is the central management, if I may say so, unity of the company. Then to this core, you have different cells that are associated with it, and these cells are basically business units, which are not separate entities, but they do specialize in different investment activities. And despite the fact that they don't have separate legal existence, these, as per the law, have separate assets from each other and from the core, and they have also, understandably, separate liabilities from each other and from the core. So this is a new structure that enables investors to come together, to put together investments. But for instance, if a given investor is interested in this sector and not the other, they get the opportunity to have the same management, to share the overhead costs, but at the same time they get shielded from the risks that are associated with another cell in which they are not interested. For instance, we may have a company as an entity that is attracting different investors, but maybe some investors are interested in, let's say, insurance, others are interested in banking, others are interested in other sectors of investment. So, for instance, if I'm an investor who is only interested in banking, and I don't want maybe to be affected by the risks that are in the insurance sector, I'm able, with this structure, to invest in this single company that is called Protected Cell Company. But at the same time, I'm sure that if anything goes wrong with the cell that is dealing in banking, let's say, I will not be affected. So this is attractive to me, and I would not be maybe interested in investing in this company if there was not that separation of assets and liabilities, because I would fear that if anything goes wrong with the cell that is dealing with banking while I'm in the insurance, then that would affect my investment. But with this structure, that is overcome, and together as investors who are interested in different sectors and therefore in different cells, we are able to have the same overhead costs shared. We are able to have the same management, the same board of directors, and all that separates us is the sector in which we are, and this is achieved thanks to these cells that they are in a protected cell company. I may say that this is something that you will find in different financial centers, and it is indeed an attractive vehicle or structure if you are to attract different investors that want to put together the resources and share some costs, but keep some sort of protection when it comes to risks and liabilities. So it's a new structure, as I said, and we hope that it will add on what we have so far. Thank you.
Thank you, Richard. Absolutely. I do believe that it will indeed add on to the current company structures that we have in Rwanda. Turning to you, Anthony. As the Chief Legal Officer of Rwanda Finance, which is the entity behind Kigali International Financial Centre, one might wonder, what makes this law, why is it important for a financial center? Why is it important for Kigali International Financial Centre?
Thank you, Michelle. So, as you've posed the question, the company law is one of the laws that investors can use as an investment vehicle. It will provide for how companies can be registered, what are the aspects of shareholding that will be considered given the different types of companies that we put in place. Some of them being, we also introduced limited life companies. These are companies that are new to our company law. And again, we are reading off from what is best practice out there. So if I can explain about the limited life companies, these are companies that an investor can set up for a particular purpose and for a particular time period. So one of the benefits here is that you don't have to go through the process of deregistering. So if I may stop at that, that would be the bigger picture of what the company law would come to provide. Thank you.
Excellent. Thank you, Anthony. I will have a follow-up question for you in a bit. Let me turn to you, Richard B. Richard Verenzi. Corporate governance is a critical element of setting up a business. And we know that the new company law allows independent directors to own a maximum of 2% shareholding. What is its significance to the role of a board and corporate governance generally?
Thank you, Michelle. Maybe before I answer that question directly, I'll just explain a bit about why we have directors in companies. And so, essentially, the idea of a company is that it's a group of investors who have come together to start a business through a vehicle called a company. And as the idea of a company evolved, it became necessary that originally the investors were the ones who used to run the company, but eventually they realized that it was better to leave it in the hands of managers who are better qualified and experienced to do the actual running of the company. And then eventually they realized that in order for them to be sure that the managers were doing a good job, they needed a bit of oversight so that they don't just use the company as a way to enrich themselves at the expense of the company and the investors who are the shareholders. And so the idea of a board came up, which is essentially a group of people are called directors, whose role was to give oversight over the managers to ensure and hold them accountable, to ensure that they do their primary function, which is to make sure that the company is run well and in the best interest of the shareholders. So that idea then eventually, originally the board was constituted by the managers themselves, who are typically the CEO and possibly the CFO, and also by some shareholders, typically the majority shareholder, or representatives of the majority shareholder. But eventually they realized that this was also a problem because the board was supposed to be involved in mainly in holding the management accountable And also, it was supposed to be involved also in giving strategic direction to the company. But then they realized that if the board was constituting of the managers themselves and also shareholder representatives or the shareholders themselves who are very much involved in the day-to-day running of the company, then they can't possibly give themselves, they cannot have oversight over themselves. It will just be, there'll be a conflict, basically, a conflict of interest, since you can't give oversight over yourself. So that's when the idea of having independent directors came in. And these independent directors were people who have no relationship to the company. And they're probably experienced in the area which the company is doing business in, or in some cases they may not necessarily be experienced in the area which the company is doing business in, but they are very, the people are curious, have experience in business generally, and have competences in other areas which could be useful to the company. And so these independent directors, the idea of independent directors came up, and so this group of directors were people who together with the rest of the board would assist in helping to hold the management accountable and strategizing to come up with a vision for the company and how it can do its business better. And also during this period when the idea of an independent company, independent directors came up, there was also an idea of the company as a good corporate citizen. And by a good corporate citizen, we mean it's paying its taxes, it's not trying to evade taxes, it's a good employer of people, its human rights record is good, it's a respecter of human rights and environment and social issues generally, and it's mindful of the stakeholders who are the consumers of whatever services or goods that the company is providing. It's also mindful of corporate social responsibility and the effects which its business has on the society as a whole. So all these are things which independent directors were better and are better at in terms of holding the company accountable to, because they are not too involved in the business that they're kind of blinded by the need to make a profit, because they are not managers and they're not directly related to the shareholders. So as this idea evolved in the previous company law, it was saying that these independent directors cannot have any shareholding in the company. And the whole idea behind it was that if they had some kind of shareholding in the company, then they would be, they'll no longer be independent. They would be, their interests will also be more like a typical shareholder. But then that thinking has now evolved in line with international best practice. What has been realized is that actually, if a director has only about 2% of the shareholding of the company, that 2% is very insignificant, and it's unlikely to have a major bearing on his or her independence in advising the company. If anything, it could be useful that this director has some little shareholding, which means that they actually have some skin in the game. They're not only advising from an outsider perspective, but they also have some interest in the company doing well. Now, this particular minimum shareholding of 2% is especially relevant in the companies where an independent director is required. Now, in Rwanda, an independent director is required first of all, in listed companies, the likes of Barirwa and Mbank, Semerwa, and more recently, MTN, the others, of course. And then also in other very regulated companies like banks and insurance companies. So that is where independent directors are actually required by law. In other companies which are not listed or very regulated, typically all the directors are not necessarily independent, and there's no requirement for them to be independent. So what the significance of this change in the law, which has enabled directors who have 2% or less in the company to be independent directors, is that it has increased the pool from which companies can draw their directors from. Because in the past, if someone had shareholding in the company, then automatically they could not be an independent director. Whereas now we're saying if they have 2% or less, they're not going to be affected in terms of how the law interprets their independence. They can still be considered as independent directors. So in my view, that means that we now have increased the pool of directors to include even people who have a small percentage in the company. And that is a good thing because they may actually enable they may also serve the interests of minority shareholders in the company, because typically most companies have the bodies has very many directors who represent the majority shareholders' interests, and that can be sometimes at the expense of the minority shareholders. So having a director who has a small percentage of shareholding in the company can also enable, or that such a director would probably be more likely to represent the interests of the minority shareholders, which is good for corporate governance, because corporate governance is not only about ensuring that the interests of the majority shareholders are taken care of, but it's also about ensuring that the interests of the minority shareholders and other stakeholders in the company who are affected by the business are also taken care of. Thank you.
Thank you so much, Richard, for breaking it down, setting the context, and telling us really the significance of this 2% shareholding. While we're still on the subject of corporate governance, Anthony, allow me to get back to you and ask you about beneficial ownership. The concept of beneficial ownership is a new addition to the company law, and we'd like for you to provide context, and background to it. What does that mean?
Thank you, Michelle. So the concept of beneficial ownership is an element that has been added to the company law, but I would want to start with what does it mean? Beneficial ownership entails that one would need to know who is controlling, who has controlling rights over a transaction being done. You might have a nominee appointed to hold shares on your behalf, but at the back of who appointed that nominee person would be the beneficial owner. Now, in our financial sector, we have had this in place, but at the level of reporting persons. And by reporting persons, I mean the banks, where they have to show information on who's the beneficial owner or the ultimate owner of the financial accounting information. Now, we have Kigali International Financial Centre in place, and as a center that one of our values is compliance. When we look at the international standards, let's start with the region. We are members of ESMALAG, which is the Eastern and Southern Anti-Money Laundering Group. And this group feeds into the bigger group, which is FATF, the Financial Action Task Force. So when you consider the recommendations and best practices from ESMALAG and FATF, and you also bring in OECD, it's a requirement that companies file beneficial ownership information with the Registrar General of Companies. So why is this done? Over time, it has shown that while the financial sector is meant to have players that follow the rules. We also have illegal activities which can promote concealment of finance that is as a result of criminal activities. Now, that we can't allow in Rwanda as a jurisdiction not to meet the international standards, and that's why the requirement to provide beneficial ownership information is now compulsory, that companies have to file this information with the Registrar General of Companies. Thank you.
Thank you, Anthony. I want to turn to you, Richard. Anthony keeps talking about the Registrar General and what needs to be registered with you. But I want to switch the conversation now to another really, really important aspect of the company law, another great addition, which is that companies are allowed to transfer registration from one jurisdiction to another. Could you please speak to the background on why this article was added to the company law and the process in which one would have to go through to effect the transfer?
Okay, thank you very much for that question. As you might know, over a couple of years ago, different reforms have been made to make Rwanda as more attractive as it can be in terms of doing business. And now another process is ongoing with institutional and legal framework reforms to make it an international financial center. So with these efforts that have been invested in making Rwanda an attractive place where to do investment, where to do business, and now a focus being put on making Rwanda an international financial center, we've been noticing that a number of companies established in various countries world over that become interested in relocating to Rwanda have been encountering this challenge that either they can expand, that is, establish a branch here, or set up a subsidiary here. All of the two options had their limitations, their disadvantages, and some wanted indeed to move from a given country and come to establish here, and maybe from here start to expand in the region, on the entire continent. But the challenge with those that wanted to come to fully establish here rather than having a branch or a subsidiary was that they had to first dissolve where in their initial or in their country of origin, and that has consequences because basically a company is born as a legal person when it is incorporated and dies when it is dissolved. So with that only option of moving here after dissolving in their country of origin, it meant that a company was in the legal sense no longer there, and then they had to start afresh from here. But again, we had to learn from the best practices from other countries where they allow for companies to relocate just like an individual can decide to give up their nationality and adopt another nationality of another country. So this is possible also for entities, legal entities, including companies, and we have introduced now in the company law provisions that enable companies that that are incorporated in a foreign country and want to move, to relocate to Rwanda. And basically what this means, in a few words, is that a company will move. It will not cease to exist as it used to be the case from the country of origin, but it will move permanently from that country of origin and come here, and then it will continue with its existence. With the previous, with the first scenario that I have mentioned, for instance, if a company, let's say, it was a company that was specialized in construction, let's say, if it had to tender for any, let's say, public tender that is outside there, if they wanted it to bid, then they could not use the previous existence because, legally speaking, they had ceased to exist and they had started afresh. But with this possibility to move from one country to Rwanda, then they will be able to keep that experience. It's just an example that I'm giving, but if we are talking of transferring registration, basically we are meaning that a company's rights, obligations, liabilities, they will remain there, but it will move with them. So that's in a few words why these provisions were introduced, and with different initiatives that are being there, including the KIFC. If, for instance, a company is now operating in a given jurisdiction and they feel like Rwanda is a more conducive, a more a proper place where they can relocate, then they will be able to do so without losing anything whatsoever. In terms of the process, the law provides a number of requirements, but basically the important thing that will be required is that from the country of origin, the law there will allow for a company to transfer its registration from that country to another country, just as we are here. So it will mean that companies are able to transfer their registration from countries that have laws that include such provisions. So once it is possible from the country of origin, then they will be able to move to Rwanda. And they will basically have to prove that they have legal existence from the country of origin, and that will be done by producing the certificates of incorporation, the articles of association, and other documents that are issued by competent authorities that this company was duly incorporated in that country of origin. And then, understandably, they will need to pass resolutions by their competent organs, depending on what the law in that country says or the articles of association say. It may be a shareholders' resolution, but basically a shareholders' resolution, but shareholders may even have empowered the board of directors that has been mentioned a while ago to take such a decision. And in addition, they will need to prove that they are not in the process of being liquidated in their country of origin, and they are in good standing, so that they can be allowed to transfer their registration here. Basically, they will initiate a deregistration process in their country of origin so that they can start a re-registration from Rwanda. And as I said, we have in our law, and there will be similar provisions in the countries of origin, provisions under which you can deregister for the purpose of transferring your registration somewhere else, as opposed to provisions where you can deregister for the purposes of dissolving and winding up the businesses. So this will be basically the process, and then they will have to submit the paperwork to the Office of the Registrar General, and once the requirements that are outlined by the law are complied with, they will be allowed to transfer their registration here.
Thank you, Richard. Thank you. It's interesting to note that we're really learning from best practice, and I'm sure that this is great news to the businesses that are looking to relocate to Rwanda. Coming back to you, Richard, Varenzi, we've spoken about different structures that are incorporated in the new company law, but there's also another interesting aspect of it, which is the tax incentives. I'd like to have your opinion on the new tax incentives in regards to, the business structures and their benefits.
Thank you, Michelle. First of all, I'd just like to explain the rationale for the tax incentives. So the thinking behind this is for developing countries like Rwanda, who do not have sufficient resources. I mean, not sufficient, but then who do not have many natural resources. One of the creative ways in which we can attract foreign direct investment is by using tax incentives to attract big multinational companies and also all other kind of foreign investors into the country. And so the new investment law decided to come up with a number of tax incentives which are meant to attract foreign investors so as to bring in more revenues to the country and also provide employment and just increase the rate of development which we're having in Rwanda. So some of those incentives are targeted at startups, and so what will happen is that, for instance, there are some incentives which are given to angel investors. Angel investors are high net worth individuals, basically rich individuals who are typical. The ones who are targeting are from abroad, but even the ones who are here are also free to take advantage of them. So those of them who are able to invest about $50,000 into a startup have certain tax incentives which come in the form of tax exemptions, for instance, on withholding tax on dividends, meaning that if they invested in a company and they were to receive dividends, they wouldn't be taxed on those dividends, whereas typically a shareholder in a company would be taxed at 15% withholding tax on the dividends. Then they also, in the case of angel investors, they're also not subjected to capital gains tax, which is a tax that you are charged when you sell your shares to someone else. Because typically with startups, what will happen with angel investors is that they will invest in the company for a certain period of time, and then once they have created value in it and their shares have increased in value, they may want to exit the company, having made some good money in it, and then want to go and invest in something else. So when they, what the new law is saying is that when they sell those shares at a profit, basically the shares have grown in value from the time when these angel investors invested in them, they will not be subjected to a tax on the profit which they make from the difference between what they bought the shares at and what they sold them at. Another group of people who are targeted are technology companies which are under the Kigali Innovation City, and also education companies like universities, for instance. We have quite a number of them in Rwanda today. Examples are ALU and Carnegie Mellon, for instance, and even Oklahoma. So those ones, some of the benefits, the tax incentives they're getting is that if they set up in the special economic zone, they will they'll be able to have a property tax holiday for 5 years, meaning that they'll not be subjected to the tax which is currently there for anyone who owns land. So they're not they're basically exempted from that tax. And then other groups of other categories of investors who are also getting tax incentives are those who are involved in research and development, financial institutions. There are also multinational companies which set up their headquarters in Rwanda. Those ones would be subject to, provided they invest more than $1 million in the country, those have a very preferential tax. For instance, if they're a pure holding company, they would only be subjected to a corporate income tax of only 3%. And then other types of companies which will also benefit service providers of some of these companies, like fund management companies as well. They have a preferential tax. Collective investment schemes as well have preferential tax, and these collective investment schemes are basically groups of people who have put their money together so as to invest it in something, in another company possibly. And part of the reason for this kind of preferential tax on those kind of schemes is to encourage Rwandans to save. So why all this is significant is that all these tax incentives will attract investment, a lot of it from abroad, from investors who would ordinarily not have considered Rwanda as an investment destination. Of course, these tax incentives are not to be viewed in isolation. There are many other things that Rwanda is doing to make itself attractive, and some of them include the ease of doing business, registering a company. We're trying to make it easier for companies to also close when they choose to close, and then also making it easier to acquire land, and all this, and also skilling the employees, the labor force in Rwanda. So all these things are supposed to work together so as to attract this foreign investment into the country. And of course, one of the things which KIFC must be considering is whether the net effect of these tax incentives will be that the country will make more revenues in form of tax or not. Because if you think about it, these tax incentives will not only benefit new players who are coming into the market, but will also benefit existing players. And so some existing players will also be able to pay less tax than they have been paying before. But I think in what KIFC has done is it has balanced it in such a way that ultimately the country will get more revenues in form of tax by attracting foreign investment which would not have previously been attracted to Rwanda. But maybe it's just something to keep in mind. There's now a movement in the world to push for a global minimum tax, which is being pushed by the US and the rest of the members of the G7, which are countries, some of the richest economies in the world. That includes Japan, Canada, Italy, France, Germany, the UK, and the US. So these countries recently started pushing for a global minimum tax of 15%, And the rationale behind it is so that really big multinational companies end up being disincentivized from going to set up in countries, their headquarters in countries which have a very low tax rate, more or less, okay, tax havens basically. So that's something for us to be mindful of. But thankfully, in the case of Rwanda, first of all, we don't know whether that global minimum tax will be passed because it has to be supported by the rest of the countries. These are just the top 7 countries which have realized that they're missing out on certain revenues because many big technology companies end up setting up in low tax rate countries. So that has been a concern for them. But as Rwanda, one of the reasons why that may not be a very big concern for us is that the tax rate has been maintained at 30%. However, for those companies which bring in economic substance into the country, there's a preferential tax which is less than 30%. In some cases, for many of them, it's about 15%, but in some cases, it goes up to as low as 3%. And the other reason why we may not be very concerned is that it's also targeted at the largest companies in the world which are setting up in those low tax rate countries, of which we've not had any such companies as yet in Rwanda. So, but that is something which we just need to keep on reviewing. The good thing about Rwanda is that it has been dynamic in terms of constantly reviewing its laws in line with OECD principles and also in line with international best practice. So in my view, the tax incentives are a welcome development. They'll attract a lot of foreign direct investment, and so the government of Rwanda will have more revenues with which to spend on the priority areas in the country like health, education, and infrastructure. Yeah, thank you.
Thank you, Richard. Thank you. It's important to highlight some of the groups that will stand to benefit from the tax incentives, which you have done very well. 2 points that you raise at the end there for us to be mindful of and to perhaps have another conversation on later. But that's something that I'm noting on my end, and perhaps we'll do another webinar on that. This brings me to my last question, and I want to direct this to Anthony. Anthony, this new law is the amendments that were made, the additions, were to some extent attract more players into in Rwanda, and more specifically through KIFC, the Kigali International Financial Centre. And a lot of them will need to be serviced by service providers. So I want to ask, how best should the different service providers position themselves to contribute to the success of KIFC in attracting these different players?
Yes, thank you, Michelle. When we talk about Kigali International Financial Centre, I would want everyone to understand that it's an ecosystem. By ecosystem, I mean we have different actors. We have the regulators, we have the professionals, be it auditors, be it the lawyers. So it's that place, or you call it a market, that brings everyone so that you can have the economic aspects of the demand and supply balanced well. So if we can go back, for example, we look at the professionals. How best can our professionals be ready for the increase in investments that are coming to Rwanda? One is to focus on the skills aspect, and it's one of the mandate that Rwanda Finance with other stakeholders we are coordinating and working together to make sure our professionals are ready. For example, we are working on setting up a skills council, and the main objective of the skills council is to continuously look at the needs of the investors. We also try to balance it with the skills of our people here so that we get professional courses. For example, in compliance, if we talk about one of the service providers that the ecosystem will need are trust and corporate service providers, but for you to provide these services, it's not enough to say I have experience, but it would also have an added impetus to it if you have undertaken the company, corporate and companies administrators program. For example, one offered by ICSA, and we also have a number of service providers that we are working with and institutions that offer these services. For example, the International Compliance Associations and others. All that we're targeting is to ensure that we upskill our people and they are ready to take advantage of the inflows of investments that we'll have. Now, if you also move away from the professionals and we look at the economy, the general economy, it's important that first and foremost, why we're looking at these inflows in the financial sector is to ensure that our contribution, the contribution of the financial services to the GDP of Rwanda grows bigger. Now, when we talk about investments, they also come hand in hand with having the right infrastructure. We also talk about the tourism sector. We also talk about the cultural aspects. So all these players, there's a demand. When you have investors coming in, they would need hotels where to stay. They will need to move around during their free time, to go visit the gorillas, and also be part of the general social amenities that Rwanda has to offer. So this is a win-win for everyone. So once everyone has done their work and they are ready, definitely the benefits are big. Thank you.
Thank you, Anthony. My takeaway from that is service providers need to rise up to the task and get the qualifications that are needed to be able to service our new incoming business investors. Thank you, gentlemen. This brings us to the next session of our discussion, which is Q&A. I think we have a couple questions coming in, and we'll start here by Caleb Kamanzi's question. Thank you guys for this wonderful webinar. Thank you for watching. Talk a little bit about liquidation of such companies. By such companies, I am going to guess that this is about protected sale companies, which is the one we've spoken about. But I'll direct this question to Richard Kayibanda, if I may, and please feel free to take it in any direction, as it was not specific to the protected sale company.
Thank you, Michelle. I assume as well that by such companies, protected sale companies are meant. Yep. So, as I have said, this is a single legal entity, a protected sale company. It's just a single company that has units including a core that may establish different cells. And as I highlighted, the purpose of these cells or this structure is to ring fence assets of each cell from the risks and liabilities of another cell. So I may say that during the life of this company, it may establish as many cells as it deems necessary to have, and the same way it may liquidate as many cells as it wants. But we need to distinguish between liquidating a single cell because maybe it's no longer needed, and liquidating the entire company. So a decision may be taken by the board to liquidate one single cell, and that will not affect, basically it will not affect the company per se, because that will be like closing a business unity, but the company is still there. And when a decision is taken to liquidate the company in its entirety, then it will be subjected to the normal process of liquidating any company, with the only exception that because this is part of the liquidation of any company to pay any outstanding debts and distribute any remaining assets. So when liquidating the PCC, we refer to it as a PCC, it will, the liquidators will make sure that assets of any cell are only used to pay debts of that specific cell and not those of any other cell. And if there is any remaining assets, they will be distributed among investors in that specific cell. But there is something important that we need to mention, that depending on the agreement between given cell and third party, they may have what we call a recourse agreement. That is an agreement where even if I'm dealing with the cell A, for instance, if it happens that assets of cell A are not enough to discharge the liabilities of that cell towards me, then I'm entitled to also look for assets of cell B. But that will need to have been explicitly agreed on in that recourse agreement. Since we are talking about liquidation, I need also to mention that liquidation of a specific cell may happen as a result of it being insolvent. That is, a specific cell is not able to pay its debts, and then it becomes legally what we call insolvent. So in that case, since, as I said, the liabilities of that specific cell should not affect the assets of another cell, then the insolvency of that specific cell, which may lead to its liquidation, will not affect other cells. And by the way, currently we are working on the insolvency law to reflect this in that law, so that the insolvency of one cell does not affect other cells. That's what I can say in regard to Kamanzi's question. Thank you.
Thank you, Richard. Kamanzi, I hope that answers your question. Next question is from Tudi Muyelo. Is there a maximum number of companies where someone can be an independent director? Who on this panel would like to take the question? Richard, since you've spoken about independent directors, I'll direct that to you.
Thank you, Michelle, and thank you, Tudi Muyelo. Yes, so first of all, as I said before, independent directors are required for listed companies and certain companies which have more specific regulation on them. Those companies include insurance companies and financial institutions, like banks, microfinancial institutions, and the like. So, with respect to these companies which are regulated, more regulated than the average companies, there is no restriction on how many companies you can be an independent director in. However, there is a restriction on, which is effectively a restriction on the number of companies, in the sense that if it's in the sector of banking, for instance, you can only be, at any one time, you can only be an independent director in one company in the banking industry. And the reason for that is really the main reason for that is to ensure that there is no conflict of interest, since one of the reasons why we have independent directors is to advise on the strategy of the company so that it can do better. There would be a conflict of interest if you were, say, a director in two commercial banks, because that would mean that you're possibly using some of the information in one of them to benefit the other, which would be a conflict of interest which corporate governance would want to address. Therefore, there is a restriction which prevents you from being a director in more than one bank. There's also a restriction which prevents you from being a director in more than one insurance company. However, you can be a director in one bank, and then one insurance company, and then any other number of companies which are not regulated. For instance, you could be an independent director in a transport company, in a manufacturing company, and so on and so forth. But like I said, independent directors are more a requirement of the law in respect of regulated companies, like banks and insurance companies, and then also listed companies. So in the case of listed companies, there is no, to my knowledge, there is no limit to how many companies you can be an independent director of at the same time, apart from that other restriction on companies which are from the regulated, very heavily regulated sectors, meaning that for listed companies which also are banks, for instance, like I&M and Bank of Kigali, you could only be an independent director in one of them. However, I know that there is a move, if I consider the case of Kenya, for instance, there is a move towards having a maximum number of companies where you can be a director in, even for the case of a listed company. And the thinking behind it is that the idea of being an independent director is that so that you can really also give a good amount of your time to advise the company so that it can do better. And if you are overstretched and you have very many independent directorships going, then you not be giving them a lot of your time. So there is also a move towards just limiting the number of companies which are listed, which you can be an independent director of. Thank you, Tudi Muyelo.
Thank you, Richard. I'll take on the next question from Dennis Kaberuka. And his question is, I wanted to understand whether a cell can use good credit rating of a sister cell under the same core to raise financing. Richard, would you like to take that?
Yeah, thank you, Dennis, for that question. It's a very relevant question. As we have said, basically, if you look at the practices of countries where they are advanced, I mean advanced in terms of they've been having protected cell companies for some good number of years. A company, as we have said, a protected cell company is looked at as a single legal entity, and the concept of cells have been introduced just to link fence the assets and liabilities. So you will find that the company is looked at as a whole when assessing its compliance in a number of regards. But for some regulators, they will have to look at individual cells. So depending on the approach that is being taken by whoever wants to assess that credit rating, then they may need to go down and look at the individual cell, in which case the credit rating of sister cells would not apply. And basically, this is when the cells are dealing in regulated activities, but if the relevant regulator who wants it to look at as a protected cell company as a unity, then they will look at it as a whole and not going to the details of specific cells, and then in that case they will look at the global picture, the global rating of the PCC as a single legal entity.
Great. Thank you, Richard. Next question is from Munyensanga Chrysostom. And the question goes, the company law looks like it does not differentiate public company from private company in terms of number of shareholders like it was before. What are the key differences? Anthony, would you like to take that on?
Sure, Michelle. So, thank you for the question. So the key aspects here that we have to focus that can be guiding on the differences between the two, one would look at the compliance aspects. With public companies, compliance is higher in relation to private companies. For example, that's why you find, for example, in the current company law, it's not a requirement for a private company to have a company secretary, while that is a requirement on the aspect of public companies. Then we also look at aspects of making public offerings, prospectus, issues of prospectus and issuing it out to the public so that they can buy shares into the company. This is another aspect that is aligned to public companies. And there are also stringent aspects with the governance in public companies, where you have a board in place, and again the boards have committees formed within them. The main purpose is to have further oversight, unlike a private company. So in a nutshell, those would be one of the key cross-cutting differences. Thank you, Michelle.
Thank you, Anthony. All right, how are we doing on time? We have about 15 more minutes left. Let's see how many more questions we can take. I see a question from Daniel Gasatura. Does beneficial ownership also apply where a company is a subsidiary, i.e., should the subsidiary then disclose the shareholders of its parent company, or does it only apply for nominee shareholders? Who would like to take on this question? Register
Maybe I can.
General?
Yes. Thank you, Daniel, for that question. So I think if you have probably you've followed, and my colleague Anthony has clearly explained the rationale behind not only collecting and keeping this information, but also disclosing it as might be required. So it definitely applies, because whenever you have maybe if I stick to the example that has been given, we have a subsidiary that is there, and then it has a parent company or the mother company, as we may say. So the requirement will go until we are sure, or we have the information about who is the legitimate. And I guess in some instances you will find that we are trying to achieve is to know who is the legitimate beneficial owner behind that chain of legal entities, and basically people were using, because some of the reasons why this information is being kept or collected is to ensure that no criminal activities such as money laundering are happening using these structures. So as long as you have not gone as far as you can to find out who is behind that chain of companies, because if you are talking of a parent company, subsidiary and so on, then we are having a chain of companies. So the subsidiary will need to disclose who are behind the parent company, so that no one is able, among others, to use this structure to bring into the clean world proceeds or money that is otherwise got from unclean sources. Yeah, that's how I would attempt it to his question.
Great, thank you, Richard. There's more questions coming in. The next question here is from Elvis, God's son. Hi, do the institutions provide trainings or internship for those who are willing, like young finance learner? Anthony, can I maybe direct this to you? I know you spoke earlier about trainings and professional certifications that are available. Maybe this is information that you could share with Elvis.
Thank you, Michelle. I believe Elvis, while he talks about internship, what I need to clarify is that I made reference to institutions that are providing training certifications. So they are not internships. That's a clarity that I wanted to provide, but if you're interested in the training certifications, we are happy to provide you with this information. Thank you.
Thank you, Anthony. Elvis, you can feel free to reach out to info@rfl.rw, and I'm sure there's more information they can share with you regarding the opportunities out there. Next question is from Christian Vugabo. There are financial institutions that are already regulated by BNR, but they would like to be part of KIFC ecosystem. Will those institutions be required to get different licenses or permits from KIFC? Back to you, Anthony. I think you're the best person to take this on.
Sure. Thank you, Michelle. So, Christian, what I want to clarify is that there is no license for KIFC. As I had said, KIFC is an ecosystem of different players where we have the professionals, the regulators. On issues to do with licensing, that remains within the ambit of the regulators. And in our ecosystem, the regulators are RDB, which would be the point of entry for any registration. And then we also have BNR and CMA, depending on the nature of the investment that company wants to venture in. So with KIFC, all that the stakeholders and the regulators that we work with at the point of entry at RDB, you register, and then they see if you qualify for the incentives and the investment code that fall within the KIFC. But we don't have a license for KIFC. That remains with our existing regulators, who are mandated to provide the licenses once you have qualified for the incentives that are provided for by the investment code. Thank you.
Thank you, Anthony, for the clarification. There's another question from Davis Mukienga. Some of the developments and new structures are yet to be developed, followed up, with changes in the relevant tax laws. So in practice, will this not bring implementation issues? Richard, Registrar General, would you want to take this on? And
Yeah,
perhaps,
Okay,
Richard, we can also add on to it as a...
Yeah, I think my namesake may add, but all I want to say is assuring Davis that a number of reforms are in pipeline to trying to align these changes that have already been gazetted with other appropriate changes like he's mentioning in tax laws and so many other laws. But Richard, you can always add on. Thank you.
Yeah, thank you. So thanks, Davis, and thanks, RG. Just to add to that, for some of those changes which are in the investment law, they don't necessarily need the tax law to change for them to be enjoyed. I think maybe Davis is referring to changes like, for instance, to the creation of a new partnership law, which has certain tax consequences, one of which is that partnerships, for instance, would be tax transparent, which means that they would not be subjected to corporate income tax, but they would be subjected to tax on the income of the partners. So for such for such a law, yes, it needs alignment with the income tax law, because the income tax law hasn't yet been amended to provide for the fact that there will be no corporate income tax on the partnership itself. However, for the other tax structures, for the other legal structures which have been given certain tax incentives under the investment law, they can actually enjoy them now without waiting until the Income Tax Act has been amended. But also, like my namesake said, Richard, there is a plan to actually amend the Income Tax Act very soon, so that it's aligned with all the other regulations. Thank you.
Thank you to you both, Richard. The next question is from Vivien Munyaburanga. In your roadmap, when do you expect to be listed and ranked on the Global Financial Centres Index? And what role do you see the KIFC playing towards Rwanda becoming a high-income country by 2050? Anthony, I think this question is directed to you.
Yes, thank you, Michelle, and thank you, Vivian, for your question. We are working on KFC being listed on the Global Financial Centres Index, and this is an ongoing process. that we are, I can say, in good stages, and we hope to be listed by the end of the year or early next year, as the process is positive. If I may go back to the second question, the role of KFC that it has to play in Rwanda becoming a high-income country by 2050. So if I may provide context here, one of the backgrounds to having KFC came from the National Strategy for Transformation, which looks at what strategies that the country can put into place to achieve the high-income country status by 2050. So what KFC is doing is that by having inward and again outward investments whereby Rwanda as a jurisdiction feeds into the African continent to be a Pan-African hub, these investments will definitely tie into the GDP, and then the financial sector contribution by increasing, we will definitely feed into achieving the target of having Rwanda attain the high income status by 2050. Thank you.
Thank you, Anthony. I think we have 5 minutes left, and maybe that's enough time for one last question. And I see here a question from Nzafashkwanayo Dieudonné, and this is specifically directed to Richard, and I'm assuming Richard, Registrar General. While you're still on the beneficial ownership disclosure, is there any exemption regarding publicly traded companies with thousands and thousands of shareholders?
Okay, thank you, Dieudonné, for such a question. All I would say is that we definitely there are going to be guidelines on this. This is something that is new, that will need some guidelines. For instance, if I may use the OECD standard, it will require countries to make sure that whoever has a stake that is above 5% of stake should be subjected to this. And if you look at such companies, you will find that most of these shareholders that are being alluded to by Dieudonné, those people and entities that will have, if you take them individually, have less than that threshold. So the law as it is does not have the exemption, but towards the implementation, there are going to be need for guidelines so that they facilitate people to know what their obligations are and who is really required to comply with that requirement. Thank you.
Thank you, Richard, and that brings us to the end of this discussion. Thank you so much, dear panelists. This was a very engaging conversation, and you shed light on a lot of the things that are now included in this new law. To our audience, I hope that you are enlightened and that you're now aware of the new corporate governance and business structures amendments of the company law, and I hope that you will take good advantage of it. I wish you all a wonderful day. Thank you.